And because we started a little bit late, we're going to skip the break and head right into Xin Wan from Uniswap. He's the research lead there, and I'm looking forward to his talk.
Oh, there we go. Okay. Today I've been talking about on-chain foreign exchange and cross-border payments. It's actually a paper that you can refer to online if you want, with this exact same title. It's joint work with. Oh, I'm sorry. It's joint work with some of my colleagues, Austin and MC, and also Gordon, chief economist at Circle, as well as David Puth, who was previously head of CLS, the International Settlement Company. Okay, this is the agenda of today. So I just realized this might be the wrong talk, as like pretty much everyone maybe knows about this already, but bear with me as I repeat what you know. But the first one is to kind of motivate the analysis and to even more motivate the case for having this on-chain FX and cross-border payment market. Then we're going to compare the payment infrastructure. The third section compares market features, like just decentralized trading of FX stablecoins versus normal traditional FX market. The fourth one is some interesting statistics we want to show, and last is missing pieces and future directions. So motivation. Currently, the FX cross-border payment costs are very high, and they involve substantial settlement risks. So, for example, this is stats I pulled from, I think, World Bank. Currently, every day, in every snapshot you take in time, non-instantaneous correspondent bank settlements are at about $2.2 trillion a day. And that just is some sort of risk that someone in the world is assuming across their counterpart, right? And cost of remittance for smaller, particularly small transfers across borders are really high. I think that number 6% is for maybe $500 transfer across border on average. Again, data from World Bank. And that number kind of impose a heavy cost for some economy that's very dependent on these sort of remittance and merchandise exports. So I'm listing these countries that are most heavily affected in terms of their share of GDP. And you can see some countries have like over 40% dependence of their GDP on remittance cost. And so it does make a lot of sense to reduce this cost to as low as possible, because you're really helping the people who are in need here. The third thing, which is partially addressed by on-chain FX and maybe FX AMMs, are the current market structure is kind of opaque and fragmented. And the rules are sort of arbitrary, because you kind of have to have every country agree to the same set of rules, which like I'm not sure if humans have ever done that in the human history. But currently, banks internalize customer flows. So you trade with a bank, and the bank might just like take your flow and internalize into its inventory, and you never be able to kind of trade through the global liquidity without setting up accounts with each bank in the world. There's limited reporting, and it's really not standard across jurisdictions. Like China has a rule. China doesn't even have free-flowing FX, but US has a rule, Europe has a rule. The liquidity drastically goes down during the weekend, basically. So from New York close to Tokyo open, and during holidays and weekends, there's very little liquidity compared to the weekdays. And finally, you have all these benchmark rigging scandals happening because of this lack of transparency. So yeah, so this is kind of a shill talk and saying that on-chain FX has the promise to solve this, but we're still lacking a lot of the infrastructure required. So I think people can agree that there's minimum settlement risk, 24/7 liquidity, privacy preserving is a bit of a stretch, but still, like if you manage well, you only show up your address. Efficient aggregation, I think, is doing quite well still. And composability, and that really addressed the liquidity fragmentation type of issue. Okay, so let's compare the payment infrastructure. So this is what you do now if you want to send your money across border and do remittance through different currencies. So the sender, for example, I want to send US dollar to some currency other than US dollar. I first send my money to my own bank in the US. And then my own bank pays a correspondent bank through the US payment system. Then this correspondent bank has a ledger that's bilaterally maintained with another correspondent bank in the country that I'm sending money to. So they will have to reconcile through, I don't know, SWIFT or something. And then that bank then does the reverse of what has happened in the US, where I send my money, and that goes over all the way to the receiver of my transaction. And each step in here, there is some delay, some cost, and some settlement risk that one party is assuming. And for assuming that risk, they're going to charge a premium or fee or something. In contrast, this is what you do if you're sending through, I guess, crypto. Some hand waving here, but basically, you just send your USDC. Well, first you go through some AMM, right? Well, first you on-ramp. And then after you on-ramp, you swap in an AMM. And there's currently an AMM pool for USDC and EURC. Then you just send the EURC to your receiver. And then that receiver has to go on the off-ramp trip. So as we can see, like the exchange and sending part is really simplified in this case. Where the issue got kicked out to is the fiat on-ramp and off-ramp system. So that's going to show up in the missing piece part of this talk. Market structure comparison, or market feature rather. So in the traditional FX market, you have like this nominal 24-hour market during weekdays, and really poor liquidity between New York close and Tokyo open, and very little trading and settlement on weekends. And even it's like nominal 24 hours, there are some weird things happening whenever, like the New York desk is trying to close their book, and I think after New York, it's Asia is trying to open, and then it's like Europe. Basically, the best liquidity are like New York morning or something, but it varies between the day. Whereas on the MM, it's always there, it's always available. And I'm going to show some stats demonstrating that that's the case. Settlement time, this is really path dependent. We have the technology to do T+0 basically, but right now we're doing T+2 business days by convention, and sometimes T+5 if it's falls on a Lunar New Year or Christmas or something. Whereas on FX, it really just depends on the finality of the chain, and you pay gas costs for it, but usually it's pretty instantaneous in a grand scheme of things. Oops. Okay. The second thing is, and by the way, everything that I show here is in the paper, so you don't really have to take pictures. They're all available. The second thing is settlement risk. Again, currently about a third of the deliverable turnovers are not settled, so they're kind of floating there in the open, and yes, it's a relatively good assumption, but you're assuming that like by the time it needs to settle, your counterparty still exists, right? And during time of financial stress, that might not be the case. And that's kind of minimized in on-chain FX because everything is atomic. If you don't give me money, I don't give you money. So there's really no counterparty risk there. Transparency and trade reporting. Yeah, I touched upon this previously, and on-chain, I'm sure you're familiar with Dune and all the other kind of on-chain intelligence service, like chain analysis is a big one, TRM is a big one. There's multiple billion-dollar businesses built on top of just discoverability of on-chain data, and I'm sure there's more to come as this market mature. And finally, there's like benchmark transparency we talked about, liquidity fragmentation. Again, in AMM, liquidities are kind of fragmented as they are in the TradFi case, but you do have all these routing service, and because everything is composable, you can kind of just route everything across different markets really easily. And liquidity providers, like this is again a somewhat contested case, as in people are saying, on the one hand, people are saying AMMs really democratize liquidity provision. On the other hand, people are saying, LPs lose money on average. I think that's case dependent. But again, it does mobilize a lot of the kind of freestanding currency that you can put into work. And there might be better designs of risk sharing and so on through new AMM designs. So some interesting statistics. I'm doing our time. Okay. Always on liquidity. So I mentioned that in traditional FX markets, you have this drop in liquidity during the weekend or on holidays. And this is showing the opposite for AMMs. So this is the market depth, or rather the average market depth of Euro C USDC pool, and the red part is the weekend. So there's really not much variation, at least across the weekday weekend horizon. There is some interesting fluctuation during like daytime and nighttime. I'm not sure if that's well motivated, but overall, it's pretty flat. And the second thing I want to demonstrate is kind of the liveness of the market. So and that's really easy to demonstrate. This is just two exchange rates through time. One is the Euro USDC exchange rate. I think it's from Bloomberg BFIX data. And the other red line is the Uniswap Euro C USDC pool price. And they do kind of track each other really closely. And like whenever they differ by some noticeable margin like this, it's not really because the AMM is out of sync. It's just because the frequency of updates for BFIX is like every couple of hours. So you just don't have enough observation during that time. And this is like sort of mechanically enforced, right? Because there's arbitrage going on, so you really shouldn't expect this to deviate. And when I first started, I showed a graph of really high remittance cost for small transactions. And here I'm estimating sort of the cost of doing a similar transaction through AMM and stablecoins. Wouldn't go into every single detail, but I think that the takeaway is it's kind of cheap. So there's a few costs. There's on-ramp costs, exchange fees, network fees, that's gas, off-ramp fee, and a total transaction. And of course, it varies based on which blockchain you use and how much you're doing your transaction for. But that's like the big takeaway is, so right now, if you do it through banks, so I'm using a $500 transfer because there's a variable part that scales with the size of the transaction. But like the average cost for a bank is somewhere in the $20 to $30 per transaction case. And I've done this many times. Like I went to college in the US and have to pay tuition every 6 months, and every time it's like $15 in my origin country and $15 in the US and some fee in between. There's money transfer operators which are cheaper, and to be fair to them, I'm picking the average number, not the cheapest number. I know there's really cheap channels from, I think, in particular US to Euro, but I don't think that represents the median user experience in the entire world. And then that's like over there is if you do it on DeFi or do it on crypto. Again, I'm sort of picking on fair game because I'm picking L2s. If you pick L1, you have to add like, I don't know, $5 to $10 of gas fees to this. But there's no reason for you to not use L2s. You can do direct off-ramp from Coinbase to Arbitrum, I think nowadays. So you acquire USDC on Coinbase, you send it to Arbitrum. There's barely any fee in this process. Okay, missing pieces. I did a lot of hand waving here. I think these are all things to acknowledge. So we don't have regulatory clarity. I think these might have been improving over the last week, but we'll see what happens after. We don't really have this decentralized ID solutions, and what that means is your experience really suck at the fiat on-ramp and off-ramp front. The custody experience is kind of bad, meaning there's that like market structure where you have to send through a wallet, you have to trade, and I work in the industry. I still get very stressed every time I do a crypto transaction on chain. There's no forward instruments, and this is like somewhat FX specific, but most of the volumes in FX is actually not done on spot, but through some derivatives. And finally, pre and post trade privacy. Again, like there's a lot of data service. Half of it is about like discovering someone else's transaction, right? And in general, you might not want that for yourself. You might want to watch other people. So that's lacking, especially for institutions. Okay, so main takeaway is blockchain technology has the promise to address a lot of challenges, but there's still a long way to go. Major benefits include instantaneous settlement, minimal settlement risk, lower cost of intermediation, enhanced liquidity aggregation, a higher uptime. And there's challenges like regulatory clarity and so on. And finally, we suggest these directions, decentralized ID solutions, forward instruments, and privacy solutions. That will be it. And just to say, I don't know if everyone is going to ECC or not. There's a ton of talks from my colleagues tomorrow. Hayden is there also, but do come to my talk also. I'm the second one. And otherwise, you're free to DM me on Twitter, and that's my personal website if you want. Thanks.
Thanks, Xin. We have time for a couple questions. If anybody in the audience has, just raise your hand.
There? Yeah, sorry. All the way in the back.
Come right over with the mic. You can start by shouting.
Spirit of the conference. Yeah, thank you very much for the talk. I had a question that connects a little bit to one of the points you said, which is the lack of forward instruments. So, of course, remittances are absolutely wild as a market. But if I look at the FX market itself, like the thing financial institutions are involved in and that they use, as far as I understand, the TradFi FX market is very, very efficient, whereas compared to AMMs, it seems to be much, much more efficient. So I guess my question is, how do you feel that connects to what you said about the, let's say, remittance markets? Like, is there some kind of trickle-down effect, or what do you think about this?
Yeah, Yeah, I agree with your point that the traditional like FX market is extremely efficient. Like spreads are 1 basis point or something, but that doesn't like it at least has not translated into an equally as efficient market in cross-border payments. And so I've been hearing this argument that all of these benefits are like regulatory arbitrage to some extent, and you can spin it that way. But the reality is like all the inertia comes from some sort of path dependency in like technologies people built to be compliant and all that, right? And so is it really a regulatory arbitrage? It's unclear to say, but I think that the benefit is sort of clear, and whether or how you've achieved that benefit is up to debate. But it's unfortunate that we have to pay like $30 for money that's going to be paid for education across a different country, and this is like one viable way of solving it.
Thank you, Xin, for the talk. Very interesting, and particularly close to my heart, as you pretty much reflected my pitch deck. So if anybody wants to know how we're solving the problem, come and talk to me afterwards, because I think we're very close. So the challenge that we're finding, and you mentioned it in your in two of your graphics there, is that you went from USD to Euro, and you went from USDC to Euro C, and then out again. So that puts a heavy reliance on those two currencies, those two fiat currencies. So point one is that as you said, the USD to Euro corridor is already pretty much well solved, certainly for retail users. So in order to actually get and solve the problem for the countries that you mentioned have the biggest problem, are we going to either need a denominated stable currency of Jamaican dollars, I'm not sure, I'm showing my ignorance here, or of the relevant countries there, Samoan dollars, or is there another solution?
Yeah, I think there's two ways to interpolate. One is, yes, you need a local currency for it to work, or as we've seen in many countries, you just need people to accept crypto payments in some other payment currency than the local one. So if you take USDT, if you take Ether, I'd be happy for everyone to take Ether. It's good for my bag, but yeah. So effectively, you just need to enable like local retail activity to be denominated in any particular currency that's supported on blockchain, and that's fine.
Yeah, and until that happens, I mean, I fully believe that's the future. Until that happens, I mean, companies like Unblock will exist. So it needs to happen. Yeah.
Thanks, Xin.
Okay.
Give him a
everyone.
round of applause.